Matt Hassan, thanks so much for joining us.
You're welcome.
Now, it's obviously been a big couple of weeks with, I suppose, the increasing threat now of the coronavirus. Interesting, though, this week that GDP figures for the last quarter were better than expected.
A little bit better. It's still pointing to pretty subdued momentum coming into this shock. The Australian economy growing 2.2% for the full year. The second half was around about that pace, still well below trend. While we're seeing a little bit of improvement over the second half, it wasn't altogether that convincing. We've got some big one-offs in there around the real estate market reigniting and around inventory build-ups that obviously aren't going to sustain growth.
Now, we had the Treasury Secretary as well telling a parliamentary committee this week that he expects about 0.5% to be shaved off March growth. Do you agree? Do you see it as likely worse, perhaps?
So that's our current estimate. Our preliminary estimate actually was around about 0.5 shaved, so taking growth to absolute zero for the first quarter for Australia. That was a preliminary assessment when the virus outbreak was pretty clearly disrupting China. What we're seeing now with more cases outside of China than within China, and in particular hotspots like Italy and Korea and Iran, over 10,000 cases now across those three countries alone, looks like we'll get a second round of disruption, particularly through tourism and travel, most likely impeding the global supply chains and global growth in the second quarter. So certainly as that flows through to Australia, there's another secondary impact that we're still assessing at this stage, but I think that's more likely to fall into Q2.
Well, on that point then, on Q2, that's zero. How far off are we then from negative? And then what are we looking like in terms of the possibility of a recession?
Well, look, it's a non-trivial risk. A technical recession under these circumstances is a clear possibility. The disruption, the impact, particularly on consumer spending, now that the big change over the last couple of weeks is the way the virus has accelerated in its spread, but also the way it's starting to flow through to financial markets and is now constituting a wider shock to consumer confidence and spending. So certainly that becomes a key risk of a technical recession in the second quarter. Against that, I think we need to bear in mind that we are starting to see more of a policy response. The RBA and the Fed have moved over the last week. We think there's more policy stimulus to come, and clearly the government is also mobilising around fiscal measures as well. All of these things, a lot of moving parts now around this the situation, both negative but also some positives on that.
On that fiscal stimulus, Josh Frydenberg, the Treasurer, has indicated there will be a stimulus package of some sort. In what form do you think that should take?
So I think it needs to be multifaceted. I think some of it needs to go straight to the calming the panic in the consumer space and providing some injection. The key takeout from the GDP this week is that, well, one of the key takeouts is that the consumer's still very much out of sorts. A little bit better, but they were the driver of the weakness last year. They're coming into this shock not in great shape, and there's clearly a confidence element to that. Clearly, you need multifacets to any policy response. The front line needs to be around health policy and ensuring a rapid response and targeting areas, the spot fires for outbreaks, and calming the public at large, that there is now a clear mobilisation of health resources that is directed at containing the virus. Second to that, I think you need to have policies looking to cushion the sectors that are most heavily impacted. Clearly tourism, education, and likely some of the retail that's in the public space. Those are areas where I think a rapid sort of cushioning measures on the idea that this will be a temporary disruption. So you don't want businesses going out of business, laying off workers because we've maybe got a 6 to 9 month disruption. They need to be able to count on the fact that they should be viable businesses in a couple of years' time and draw on that. And then thirdly, sorry to interrupt, but thirdly, we do need some wider economic stimulus to generate a bit more momentum across the broader economy. So I think at least those three.
You mentioned the movement by the RBA, cut rates. Does it surprise you that was, it should be said, handed on very quickly by Westpac and the other majors? There was some commentary by the Prime Minister perhaps pushing that along. But the rate cut, are you surprised they went so early? Because, what we're dealing with is a supply issue. Is a cut to rates really going to make any difference, do you think?
Well, It will at the margin. I don't think it's something. That's why we need this fiscal response, because ultimately, no amount of interest rate cuts is going to encourage people to go on holidays and go out in public when there's a threat to life involved. What it does at the margin, though, is it lowers the carrying cost of debt. So for small businesses, households in particular, their ability to service debt gets a little bit easier at the margin. It gives a little bit of a cash flow injection at the margin. But it's not going to really snap at the economy. It's about cushioning the economy rather than driving an upturn. And I think we're sort of seeing that with the reaction to the Fed's 50 basis point cut. Yes, it was welcome to begin with, but in and of itself, it's not seen as sufficient to really, it's cushioning a slowdown rather than driving a turnaround.
And you're booking in another cut for April, though, already?
Yeah, we think they'll move again in April, and really, given the situation is pretty live, in particular in the US, and in particular with the US being so much more sensitive to confidence around the consumer space, there's a clear risk that the Fed may need to go further with its policy easing to try and cushion this effect.
And just quickly on housing, you mentioned some movement there, some good news there on housing, but is this going to start affecting that bright spark, what that was housing?
Well, clearly housing's in a separate situation than the wider economy. We've had a clear rebound, a strong rebound since middle last year for the housing market. It's become more convincing. It's carried into early 2020, into January, February. How these shocks play through to the housing market, it's quite complex. So on the one hand, that's the most interest rate sensitive sector of the economy. So a further rate cut, particularly having been passed on completely to variable rates, does give you a little bit more momentum on that front. I think the key for housing, what we find when it comes to house purchase decisions, interest rate settings are important, affordability is important, sentiment around the housing market is important, but the other key element is the sense of consumers' job security. Yeah. That's the thing that can put these big ticket decisions like house purchase on hold. So for me, again, that labour market piece, whether consumers start to freeze up because of concerns about losing their jobs, that'll be a key element to the reaction of the housing market over the next few months. So far, there doesn't look to have been anything. The auction results for the first few weeks of February and March have been very strong. But the next few weeks, we'll start to see some of these elements from the coronavirus effect start to come through into housing, and the key aspect will be whether consumers who were previously planning to buy go on hold.
Okay, Matt Hassan, thanks so much for joining us.
You're welcome.